in taking business decisions. That business decisions are generally categorized into three categories. Please make a note. We have investing decisions, we have financing, and then we have dividend decisions. Where do you need to invest? That will come from investing decisions. What are the different sources from where you would raise finance or funds in order to run your business? That are financing decisions. Dividend decisions is whether you should give dividend to the business owners or you should retain the funds in order to reinvest in the business. So these are the three broad categories of business decisions. And in order to take relevant or appropriate or adequate business decisions, we need information. That information is provided by the financial accountant to the management accountant and thus is being used by the top management. Plus, it indicates how successfully managers are performing. So, what the overall performance of the business and who is running the show? The managers are the ones who are running the show, and how successfully managers are performing come to know with the financial accounting. Along with it, provides information about the resources and activities of business. And this is important point. When we talk about resources, we are talking about what is the sum of all assets that we are having, along with the sum of liabilities the business is having. And when we talk about activities, we are referring to the operating cycle. Before I move to the next slide, I would here like to take an opportunity and would give a hint on these three terms. One is the assets. What do we mean by assets? Assets are the economic resources that a business has control on, and these are the resources that has a capacity to generate future economic benefits to the business. Whereas liabilities are those which are generated as a result of business activities, and these liabilities ultimately are the requirement of the business to be paid to outsiders, right? Business need to pay to somebody, that is a liability. And why it has happened? Because business was doing some sort of activity for which it required services, and the result of this management of asset. Now, what is operating cycle? It's like you have, let's take up a simple manufacturing concern. It has raw material. It will convert the raw material into work in progress. Then this work in progress material will be converted into finished goods. Then these finished goods would be converted into sales. Sales would be either cash sales or credit sales. And then these cash or credit sales would again generate revenue for the business. And this revenue would be used to buy raw material. And this whole circle of business activity would continue. And this circle is known as operating cycle. When you buy raw material, you need to pay to somebody, some supplier. There you create a liability. Raw work in progress, you need to pay the employees or pay administrative charges. Okay, there are liabilities, expenses. Finished goods, when converted into sales, you will be paying the marketing expenses. Okay, so the result of this operating cycle is creation of expenses, which ultimately lead to creation of revenue. And thus, here this whole cycle continues. Assets, raw material. What is raw material? Raw material is an asset. Asset leading to liabilities, liability leading to assets. This circle continues, the cycle continues, and thus the business grows. Now, the question is, why should a business keep this accounts? The first point is to discover how well the business is doing, whether the business is making profit, earning losses, to record all the assets or liabilities, to keep a record or a snapshot of assets and liabilities. What do we call this? A snapshot of assets and liabilities. We call this as balance sheet. To help run the business efficiently, because you'll understand where are you making expenses, what were the points where you paid over or extra, what was the wastage and other things. All of this comes to know, all of this a business comes to know if it is keeping records, and that too along with the monetary records that we call it as accounts. So why should a business keep accounts? What is the correct option here? The correct option is option D. So now that takes us to this point. What do we mean by accounting? Accounting is a process of collecting, recording, summarizing, and communicating financial information. Accounting is not focused only on keeping records. No. First of all, we need to collect all the information that is required in order to prepare financial records. So what type of information are we collecting? It is related to events and transactions. So in a business, there are two things. One is event, another one is transaction. So business has a number of events that are taking place. Those events are lead to transactions, and those transactions are ultimately recorded. Now, events can lead to two effects. One is the explicit effect, another one is the implicit. When we talk about explicit effect, what are we talking about? We are focusing on something that has happened, and the effect of that event or that transaction is readily visible. Let's take up an example. The example here is cash sales. So now here, the sales has taken place and the type of sales is cash. So what has happened? There are two things. You made sales, so goods have gone out of business, goods being sold, plus you received cash.
Excuse
There
me,
are
ma'am.
two,
Sorry,
yes,
sorry to interrupt, but I guess there is someone in the lobby who's waiting to to come inside the meeting. So can someone accept it?
if I go,
I guess it's Vicky Srivastav.
right? So we were here. There are two things. If a transaction is an explicit transaction, we have cash sales. There you received goods, you sold goods, and you received cash. So two things got affected, and both were quite visible, and you recorded. The effect of the transaction is over. So this is collecting information. Another one is the event. The event can another type of event can be an implicit. So there are two types. One is explicit, another one is implicit. What about implicit? When the effect is not duly visible right at the time of transaction, the total effect is not there. For example, uh, let's take up an example of amortization of intangibles. Or you have a copyright. You bought the copyright belongs to you, but you know that the life of the copyright is only of 5 years. Let's assume that the remaining life is 5 years. So now there is an implicit or an underlying event that is not visible but is happening. What is that implicit event? Is that the value of the copyright is deteriorating. You need to account for that. That is implicit. Another one that we take is too early to introduce that concept, but leads to accrual concepts. We'll discuss that later on. Right now, we need to understand that accounting is a process of collecting. When I think about collecting, I'm talking about financial information. That financial information can result because of two things. One is either financial or either business events or business transactions. Now, when we talk about events, we can have two types of events. One is having an explicit implication, or another one is implicit. Now, once an event or a transaction has happened, the business needs to record that The business needs to collect the information, and after the collection of information, it needs to record. And for recording that information, in order to record that information, what the business has to do, it has to follow some rules of recording. And those rules are the ones that we are going to discuss. And these rules are broadly guided by accrual accounting, okay, plus double entry system, which we will discuss in some time. And then summarizing. Summarizing means preparing financial reports. Communicating means conveying those or presenting or publishing those records in the form of a snapshot or in the form of a balance sheet or income statement to the users. Now, that takes us to our next point. What do we mean by nature of accounting? Accounting can, if you look at the nature of accounting, it should have four different and important concerns. As one is, it should be understandable, understandability. Second one is relevance, reliability, and comparability. So when you're recording financial transactions, they should be recorded in a manner that is understandable. That means the the language that is used for financial accounting should be universal. Relevance, it should be relevant to the user, the one who is using it. Reliable, so it should be as much unbiased as it can be. For enhancing the reliability, there are accounting standards that must be followed. Comparability means the consistency of accounting policies that are being used. What are the functions of accounting? The functions of accounting revolve around the circle, that is the accounting circle or accounting cycle. That is, the first function is recording all the transactions. Whatever transactions are happening that must be recorded, the recording is in the form of a journal or and then taking it further to the ledger. uh, Journal is the first book of entry where all the transactions that happen are recorded. Once the transactions are recorded, then they are classified on the basis of different accounts. And on the for the classifying them on the basis of different accounts, we have ledger accounts. So from journal we prepare ledger. Once the ledger is prepared, now the summary of that account balances is prepared in the form of a trial balance. And then from that trial balance, a report is prepared. Report is in the form of income statement or balance sheet. And then analysis and interpretation is done. Analysis and interpretation is done, but it's not the function of financial accounting. It is this analysis and interpretation is more of a function of a management accounting. The focus of financial accounting is to prepare final reports and present it for further interpretation. So, what are the main objectives of financial accounting? The main objectives of financial accounting is to keep systematic records, to keep records following all the rules and regulations of financial accounts, to determine the operational profit and loss. This is the main objective that we require, that we need to determine what is the profit or loss of the business, to understand or to protect the business belongings. See, in order to protect the assets of the business must know what are the assets. And when I say protect, it doesn't mean the physical protection. It means the protection of economic value of the business assets. Right? You need to reduce your assets as their value deteriorate so that you can protect the economic worth of the business. And then in case there is an appreciation of an asset value, that should also be recorded. Then the next one is to ascertain financial position of the business, to determine what is the net profit or loss of the business, to facilitate decision making. Once the financial information is prepared, the second step is to facilitate or to enable the management to take decisions. Who are the different users of accounting? The users of accounting can be categorized into two forms. One is must be knowing internal users. Okay. The second one is external. Who are the internal users of accounting? Those who are present in the organization. Okay. They are directly related to the organization. And who are external? Those who are not part of the organization and are uh, not directly related to business, but they are indirectly related to business. Let's take up an example of internal users. The first internal user of accounting is management. Second one is because it's a management who would be using this accounting information to take a number of decisions. Second one is employees. They would like to look into the financial position of the business in which they are working in order to understand what is the growth rate of the business, what all uh, are the assets and what is the potential of the business. And then the most important user, rather it should have the most important one. Can you guess the name? It is the shareholders. Why are we preparing financial accounts? Who is who is the main or primary beneficiary of financial accounts? This is the shareholders or the investors. Okay, and then there are the creditors, those who have given money on loan to us. They are the creditors. They would also like to look into whether the business has a capacity to repay the debt it has taken. And then you have debt holders, etc. And who are the external users? External users, the first one is the government. It would like to see what is the tax that the business has paid, tax liability of the business. Then the banks. Banks can sometimes be internal user, can be external user. Okay, you go and ask for money from the bank, it would be an external user. Banks want to look at the financial position of the business. Then potential investors, those who are not investors but are thinking of investing in your business. And then you have media. Okay, so media is there who would like to publish the current state of the industry, and it would be interested in the financial accounts in order to understand what is the financial position of the business. Now that will take us to the question. It is easy to see how internal people get hold of accounting information. A manager, for example, and can ask the accounts department to prepare whatever accounting statement he needs. But external users of accounts cannot do this. How in practice can a business contact or a financial analyst access accounting information about a company? What would be your answer to this? Is the financial information or accounting information available to a financial analyst or a business contact who is willing to look at the business information? Is it available to them? Yes or no? So whatever financial accounts or accounting information that is prepared by the company, it must be available to the financial analyst and it must be disclosed according to the rules and regulations. It must be the audited financial statements must be published by the company so that the general public can access that information. Okay. Now, this takes us to the basics that we require in order to build up a base for this subject of financial accounting. The first term that we need to understand is asset. What do we mean by an asset? So, Let's have a look at this. Asset is something valuable which a business owns. So, in order to understand this terminology, the first point we need to understand is it is something on which the business has control. The first point. Second point is it has a right to use. Okay, right to use. And the third point is that it must have capacity to generate economic benefits. Okay, so if you understand these three things, you can define an asset. What is that? First thing is, it is something on which the business has a control. Second point is, the business has a capacity, has a right to put that thing into use for the purpose of business. Third is, it has a capacity to generate, but what? Generate revenue, or we can say generate future economic benefits. So these are the 3 points that actually are used to define the term that is known as assets. Now, assets are further of two types. One is current assets, another one is non-current assets. Now, current assets are the assets that have a life of only one operating cycle. There are two popular definitions. So the more appropriate definition of a current asset is it is an asset that has a capacity or has a life of only one um, operating cycle. And the other one is it is asset which has which can be liquidated easily or has a life of one year, 12 months. The examples for current assets are cash, raw material, finished goods, cash and bank account, or debtors. Non-current assets are those assets which would give you economic benefits over a longer period of time, that is more than 1 year, and have a life of more than 1 year. The business has to keep them with, and they depreciate over their life. The example is factories, office building, warehouse, delivery. But there is one asset that does not depreciate over a period of time, rather, it appreciates. The non current asset is land. Brand is also a non current asset, but it is more of an intangible asset. Now, assets can be further divided into intangible and intangible assets. Now, what are the intangible assets? What are the tangible assets? Tangible assets are those assets which can be touched, which you can see and have their physical existence. Whereas in case of intangible assets, they don't have physical existence, but they do give future economic benefits. Now, liability. Liability is something which is owned to somebody else. Liabilities can be current liabilities, non-current liabilities. Current liabilities can be when we talk about um, the current liabilities. These are the liabilities that the business need to pay within a one accounting year or within one operating cycle. The example is creditors or short-term borrowings. The non-current liabilities are which extend more than 1 year or more than one operating cycle. Shareholders' equity, bank and bank or debt, bank loan or debt. Shareholders' equity is a non-current liability. Why do we call this as a non-current liability? Because we assume that the ownership of the business and the business, owners of the business and business are two uh, separate entities because we believe in the concept of separate legal entity. So a liability is something which is owned to somebody else. Now, capital. Capital is a special form of liability. What is capital? It is the funds that are provided by the owner of the business to the business so that business can run and can generate revenue. It actually represents the amount that is owned by the business to the proprietor. So the business is liable to pay back the amount it has taken from the proprietor to run the business. Now that takes us to the accounting equation. What is accounting equation? The accounting equation is something that balances our balance sheet. So it says that assets are equal to liabilities plus shareholders' capital. So now let's take up an example. On 1st July 2022, Mr. Bahubali opened a tea stall in a local market to sell teas and snacks. He had 25,000 business. When the business was set up, he has cash amounting to 25,000. Does he, but does it owe anything? What is your answer to this? I'll leave this to you. Answer is yes. What would be the accounting equation for that? Assets is 25,000 because he was cash. Okay, this is the amount of cash. Liability, the one he gave to the business, that is 25,000. He was not having anything else. He could have bought something, but this is the first basic accounting information. What if he buys 10,000 of furniture of 5,000? For example, he buys furniture of 5,000 out of this cash. So what would you say? You'll say cash will become 20,000 plus 5,000 of furniture. This accounting equation would then change like this. Okay. Now the next key term is drawings. What do we mean by drawings? Any sort of amount that is taken by the business, taken by the owner out of the business is called as drawings. But the point here is drawings are the amount that is taken by the owner for personal use. Okay, it is not taken by the owner for business purposes. It is for the personal use of owner. First point. Second point is it reduces the capital. Okay, and the third point is owner needs to pay interest on this. Now, accounting concepts and conventions. So, accounting concepts and conventions, we have accounting principles, which are further categorized into accounting concepts and accounting conventions. Let's discuss accounting concepts first. So, first is business entity concept. What does it state? That states that the financial accounting treats business as a separate entity. So, what does it mean? See, this is business and this is the owner. So, they are two different entities. They are not the same. When it comes to the legal status, business and owner are different. Okay, they are separate. And that's the reason the owner's capital is liability. It is not the capital of the capital owner's capital invested in the business is liability of the business because of this thing. Okay. Now, implications. What is the implications? Financial statements must not mix assets and liabilities with personal assets and liabilities of individual owners. That means owner has some sort of personal assets. These are not equal to. These are not equal to business assets. Okay. Assessment of owners' equity and liabilities can be done only with the help of this separate legal entity. And it is basically an acknowledgement of economic reality, legal reality of the company. Legal reality means that business and owner are different. The second important concept is money measurement concept. What does it say? That all the transactions that are taking place in a business must be recorded in monetary form. So monetary transactions are to be recorded at all the times. Implications of this is it brings in reliability because you have everything that has been quantifiable. It makes assessment more objective and comparable, and it ignores the qualitative aspects, including the financial position of business. Next one is the going concern concept. The going concern concept states that the business will continue till infinity. So we are not assuming that the business will close down or be forced to close down. The business will continue. And because of this concept, whenever a balance sheet is prepared, it is prepared with this thing in the mind that the business will continue. Otherwise, the balance sheet, that's the reason the assets are valued, and that is the reason how we assign depreciation to assets and amortization to intangible assets, because we are assuming on a going concern concept. Another key implication of this concept is the valuation of assets. So whenever there is a valuation of an asset, we look at all the future economic benefits of that asset. How do we find that this is the value of an asset? So in that context, this concept plays a huge role, because we assume that the business will have sustainable future profits, and that's how the value of business and the value of asset is assigned. It influences the valuation of assets and liabilities, because it enables us how much depreciation you need to assign each year. If you assume that your business is going to, or the asset is going uh, uh, to to be withdrawn from the company, or is the asset will be shut down during next 2 years, then the rate of depreciation will change altogether. And it provides understanding of assumptions and strategic decisions. Accounting period concept. Accounting period concept states that the accounting statements or financial statements are prepared for accounting period only. What is that accounting period? That is 1st of April to 31st of March. That is the accounting period. So all the statements are prepared only for this. And why are we doing so? Because we need to understand that the accounting statements need to provide information, and for that we need to provide some stock point. In order to understand this a little better, there are two concepts. Let's discuss it. When we talk about financial statements, we are focusing only on two things. One is the income statement, another one is the balance sheet. Okay. So when we talk about income statement, I'm referring to profit and loss account. Here it follows the flow concept. That means what was the inflow of income or outflow of expenses, all that during a one given year. That is from 1st April to 31st March. What was the total inflow of incomes? What was the total outflow of expenses, of cash, total cash outflow due to expenses? That is shown for one accounting period. So this is income statement that is prepared, whereas balance sheet follows the stock concept. It says what is the total amount of assets and liabilities that you have on a given time period, or on a given date. That's the reason why when we look at the balance sheet, it is written balance sheet as on whatever the date is, and profit and loss account, it's written for the period. Now, the implications is it helps in preparing the final accounts or the financial statements. Along with, it helps in making an assessment of business performance, which is comparable over a period of time. Uh, and the most important is it provides a basis for periodic matching of expenses with revenue. It's a major concept that how do you find profit? You find profit when you have revenue. Okay, you reduce expenses, and whatever remaining is your profit. How do you find profit? This is the profit that the business will have. You remove all sort of expenses from the revenue, remaining is profit. Now, which expenses to be removed, to be deducted from which revenue? How do we understand, make an understanding or generate an understanding of this? In order to do that, we need to have some principle, and that principle is the counting period principle. The When it combines with other principles, we can make adjusting entries. The next is dual aspect concept. This is core of financial accounting. What does it say? It says that there is a transaction. It will always have double aspects. One is the debit, famous one. Another one is the credit. Another thing is a transaction would always affect two accounts. One account and the second account. That is the dual aspect concept. So a transaction has always dual aspects. One aspect is debit, another one is the credit. So the amount of debit aspect will always be equal to the amount of credit aspect, and it will affect two accounts at the same time, or it can have the same account but in uh, in a dual manner. Next one is the revenue recognition principle. What does it state? It is a deeper concept that needs much more deeper understanding. But it says that you recognize the revenue for the only for the given accounting period. Yeah. We'll discuss this concept in the next session because we would require more time for that. Next one is accrual concept. What is accrual concept? It means that incomes and expenses are included in the income statement of the period in which they are earned or incurred, not received or paid. This is very much important. Why so? Because it says that there is an income that has arisen. Like suppose there was a customer who required goods from you and you made delivery of that goods. So income has arisen, but you haven't received the cash, whether you would record that as an income of this year or the year in which you would receive the cash. You would record that as an income of the year in which it is earned, but on the basis of accrual concept. But you would at the same time also mention that you have not received cash for that. To understand this in a much better way, we can have a look at this example. So there are a few transactions which has taken place. This is the quantity and the amount. So the transaction takes place, there is a purchase, you made a purchase on 7th May and made the payment on 1st June. Then there's the sales which take place on 8, 12 and 23 May, and the payment is made on 1st June for all the transactions. You are expected to compute the profit for the month of May on the basis on cash basis and on accrual basis. On cash basis, what do we do? If it is on cash basis, then we record only those transactions for which we have either made a payment in cash or we have received the payment in cash. If no cash exchange has taken place, then we won't record that transaction. So let's look. If profit is to be calculated purely on cash basis, then we can see here that the quantity of was purchased in the month of May, but payment wasn't made on month of May. It was made in June. So no cash take place here. No cash take place in for sales as well. We haven't received any sort of cash, though we sold 4, 6, 10 quantities. And for that, the amount due was 40, 60, and 100. So total of 200 is the amount of sales that we have made, but yet we haven't received any sort of cash for that sales. So if we are making an account only on cash basis, then we have received zero cash and we have made a zero payment. So profit or loss for the month of May is zero only on cash basis. Now let's look at a different perspective, that is the accrual basis. So on accrual basis, though you made a purchase of 100 rupees, but you haven't made any payment in May, but you have done this, carried out this transaction, that must be recorded. But since no payment has been made, so it's a sort of liability on the business. And for sales, you have got the sales of 200 rupees, but no payment has been received. So it's in a sort of uh, an asset to the business for which the revenue would be there in future. So what is the total profit for the month of May? The total profit for the month of May is 100 rupees, and accrue it is on the basis of accrual basis. So accrual basis provide a better and a truer picture of business financial position. So that takes us to accounting conventions. They are the rules of accounting game. One is consistency. What does it state? That the same policies and accounting principles should be adopted consistently. They should not be changed with the passage of time. Second one is conservatism, that we must provide for all sort of possible losses, which we assume. If there is a loss that is uh, can be foreseen by the business, then it must be considered. And if there is a revenue which has not been realized till now, then we must recognize all sort of losses that can happen over there. Example is, for example, you made sales and you are waiting for the payment, and you somehow come to know that the customer has gone bankrupt. Then, according to the concept of conservatism, you must record that sales as a bad debt. Convention of disclosure. What does it mean? It means there should be full disclosure of accounting information. Convention of materiality. All sort of material information must be disclosed. Now, what is material is relative. It varies from situation to situation and business to business. Now, how do we define material information? Material information is any sort of information that has a capacity to change the decision of the investor is a material information. For example, your business incurs 1 crore rupees only on the stationery. And if there is a purchase of 100 or 1000 rupees, that is not material. That is not going to influence the decision of the investors. So that's an immaterial information. Whereas on the other hand, if your business is making a purchase of 1 crore of stationery just for administration purposes, and there is a huge purchase of, let's suppose, uh, 50 lakhs of something, that's a material information, must be disclosed. Even though the context here or the account header here is the stationery. But that takes us to the double entry system. We have already discussed this thing. It says that every transaction has double aspects. One is the debit and another one is the credit. And that's all for today. We'll discuss the revenue recognition principle as the first principle that in the next session. Thank you. I'm open to questions now. Yes, yes, please. Yes, yes, right. Yeah. See, yeah, it can happen. So what the point I wanted to, well taken your question, I've understood your question. The point I was trying to make here is the difference between the accrual basis of accounting and the cash basis of accounting. So if it is an accrual basis, you would recognize all the revenue, right, which you have earned, whether you have received or not, whether you have received in cash or whether you have received in credit. It means whether you have received or not, you will recognize it as a revenue of that year only or that month only. But if you're making your accounts on cash basis, then you would record only that revenue that you have received in cash. And that's the reason cash basis of accounting is not practiced. We practice accrual basis of accounting because it gives us a better and truer picture. And mostly 90%, 99% accrual basis of accounting is followed. It was followed in, it is one of the forms of accounting, and we must know that. No, just a second. Now, when you're asking me this question of bonds, what you're thinking is your company issuing bonds or are you buying bonds? So if you are a shareholder and are you a company or an individual? You you are an individual, so you're not a company. Okay. So you are an individual, you buy shares, you buy bonds. So you're maintaining a portfolio here. Okay. So your bonds, shares are assets to you. They are not liabilities. Okay. So if a bond is of how long is the mature? What is the term of maturity for the bond? More than 1 year? If it is less than 1 year, it's a current asset. If it is more than 1 year, it's a non-current asset. Though you will keep on receiving the interest income. Sorry? Yes. Yes. Even for taxation purposes, if you look at, so they say that if it is within 1 year, what do we say what type of tax do we pay? Short-term capital gain. And if it is for more than 1 year, it's long-term. Right? But that's not under the part of this financial accounting context that we are studying in this class. This was more towards the personal wealth management question. Okay. Any other question? So,
Okay, ma'am, if there are no more questions, we can close the call since we need to go to the next class.
right. Thank you, sir. Thank you.
Okay, thank you. Thank you, learners. Thank you very much, ma'am. Thanks.